Joining me is David Bahnsen. He's the Chief Investment Officer at the Bahnsen Group. David, welcome. What do you buy today?
Well, it's getting to a point where there's quite a bit that one could buy. It's not so sector selective. We'll see if that full capitulation comes. It's interesting to me, Kelly, that energy is still up on the year, even with these last 5 or 6 days. And it's further interesting that bond yields are dropping and, in fact, have dropped about 13 basis points in the 10-year over the last 5 days. So this whole narrative that equities are dropping because the Fed's raising rates and the bond yields going higher is completely inaccurate. The stocks are dropping because certain parts of the market got way overpriced.
So, but would you agree that the catalyst for the correction is the normalization and the Fed's tightening?
No, I would not. I think that the fact that the Fed was going to be raising rates this year was known a month ago, 3 months ago, 6 months ago, and not just known, really known. Smart money, dumb money, retail, and everybody knew there was going to be some form of tightening, some form of normalization. I actually don't even really agree with the word normalization, although I definitely know what you mean by it, and I agree with that. They're headed towards a place of a more normal path. But I think normalization would have a Fed funds rate much more than where they're going to go. And a normalization of the balance sheet would get us back to $4 trillion. They're not even going to get close to that. So they're going to be tightening on the margins. But no, I think the catalyst here is that valuations got stretched, and valuations always have to adjust. It's just we never know when.
So what are your conclusions about the Fed from all of that? It sounds like you want them to be more aggressive than what the market is currently even talking about.
That's a fair way to put it, but I don't think it's that I want them to be, because all I can do with client capital is invest around what I believe will be. And I do not believe the Fed is going to be more aggressive than they're saying. And in fact, I don't believe they're even going to get to 4 rate hikes this year. I think they'll end up chickening out at around 3. But look, the high yield bond spreads as of this morning were only about 290 basis points. Credit is not yet reacting to this sell-off. I assume things have widened a bit in the last few hours, but not by much. 2018 was sort of the level where you saw what happens. Credit spreads blowing out and the Fed responding. We're not even close to that yet. So I think the Fed will do a marginal reduction of balance sheet through roll-off, and I think they'll get about 3 rate hikes done this year.
Shepard Smith here. Thanks for watching CNBC on YouTube.